Good afternoon. Welcome to today's stream on Twitch. Today's Wednesday, and because it's Wednesday, we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. If you like what you see here, you want more content from me, you can always follow me on Twitter at StockDarts. You can find videos from me at YouTube under the name StockDarts, or you could visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, as well as generally just going ahead and expanding on some of the conversations we have during these Wednesday market streams. Typically what we do on these Wednesday streams is analyze the market, try to figure out what type of environment we're in, and how we should go ahead and approach and trade it. And then once I do that, I come up with appropriate trades that sort of mimic what we think is going to happen in the market. And that's where you'll typically find those ideas, is over at patreon.com. Some of that stuff is subscription, some of it is free. Even the subscription stuff typically goes free after a certain amount of time for those that maybe are just looking to learn and don't need the timely information. Other than that, let's go ahead and get started. What we want to do today is go ahead and take a look at the S&P 500. We have Thanksgiving for those of you in the United States tomorrow, so it's going to be a shorter week than normal for the markets. We're going to have, obviously we're going to be closed tomorrow, and then Friday is going to be kind of like a half day. So we're kind of seeing most of what we're going to see for this week with today's price action. We will see a little bit of movement on Friday, but typically those really light volume half days don't do much as far as impacting the overall markets. This Monday when we were looking at it, we were thinking possibly the market was going to try to rally. This is what tends to happen during these holiday weeks. Unless there's a lot of bad news that's really impacting the markets, we tend to drift upwards during weeks like this and as we head even closer to Christmas. And so the market looks like it's gearing up to try to rally. Even if we just get a small Christmas rally, maybe not one as strong as the one from the end of last year, but it looks like we want to kind of drift up. It's not what it looks like here on the S&P 500 chart, but as we move through and we take a look at the Dow and IWM in particular, and even NASDAQ to a certain extent, you'll see that the market is trying to rally, and we are, for the first time in quite a while, at or very near all-time highs on all four market indices. Throughout the last several years, the market has often been at new highs, with IWM lagging behind or with the Dow lagging behind by a little bit. This is the first time in a while where we actually have all four of the indices holding together and breaking out together, which typically would bode well for a stronger move and a good rally. So at the moment things are looking pretty good. And for those of you that are nervous about the market, I don't think we need to be nervous at the moment. Things are looking pretty good, and it's just a matter of making sure that we take advantage of the right momentum and that we understand what kind of rotation is going on. And I think that's one of the things we've really been kind of discussing over the last 2 or 3 weeks is this rotation, as money has started to flow a little bit away from tech and from some of the bigger names in the S&P 500 and going towards some of the more volatile assets, some of the more beaten down equities that have struggled this year. Particularly in the Russell 2000, but generally speaking, just names throughout all the indices that have really had a tough time with the coronavirus shutdowns that have been taking place. Stuff like airlines, restaurants, movie theaters. Those are the kind of names that seem to be recovering right now. And of course, this is all in the hopes of vaccines coming out towards the end of December and into the start of next year. And so the idea is, if these vaccines are widely spread enough, and if we have enough of them, and if they're effective enough, that we should get back to normal. And so the hope is, if that's the case, then some of these names that have really struggled as we continue to stay shut down, and as we start to shut down again into the winter, into the holiday season and into the winter months, the hope is that those names start to benefit once we do open up again, once we have a vaccine in place and we're actually delivering it to people, and it's actually working. So the market is expecting that, and that's why we're seeing money rotate towards those names and away from stuff that has done well all year, because we've been stuck at home, right? And so we covered this last week and the week before, but we've divided our trades this year, as far as I'm concerned, and those that follow me on Patreon. There's been two basic trade theses, right? And one of them is the names that benefit from those that stay at when we work and stay at home. Stuff like Netflix, Amazon, Zoom, Peloton. There's a big variety of those names, but the type of names that benefit from the world's consumer base having to stay at home and do all their consumption from home, whether it's entertainment, whether it's actually shopping or whatever it is. And then the other side of that trade, of course, are the companies that have really struggled as we've been kind of relegated to staying at home and shopping from home. So traveling names, stuff like airlines, stuff like hotels, casinos, restaurants to a certain extent. Those types of names have struggled because our economy has kind of shut down a bit as people have been kind of stuck at home and not been able to really go out and do the normal consumption that we do across the board. And so those two ends of the same sort of spectrum have been a big part of how we've gone ahead and attacked this year as far as trading is concerned. And I've recommended a tech-heavy portfolio pretty much throughout the year. And I'm not really ready to give that up yet. I think, again, a lot of these names that have benefited from us staying at home, this was a trend that was already in place prior to the COVID-19 pandemic, and is a trend that I expect to continue moving forward, particularly as companies have seen that it's possible to have their employees work from home, and in some ways it leads to a little bit more efficient workspace. And so this is a trend that I think is going to continue. So while those names may be taking a breather right now, and may even struggle for a little bit, I think long term those are still good names to be invested in, and names that I think will still benefit from the trends that I think are in place across the board. So with that said, let's go ahead and take a look at the ETF SPY, which of course is a representation of the market index, the S&P 500. And as you can see, this is actually struggling to break to new highs, right? So you can see we've got a triangle forming. I can go ahead and reappropriate this trend line and move it on like this. And you can see we still have a triangle. So the short-term trend kind of slowed down, but we still have the intermediate-term trend still doing kind of the same thing, which is basically the market keeps climbing up, but it can't break these recent all-time highs right at 364 on the SPY. And so, if you look at this, you'd think, well, the market is kind of struggling here and maybe ready to roll over a bit, but when we go ahead and analyze the four market indices, what we'll see is that really the S&P 500 right now is kind of lagging behind, but I still suspect that it will try to break out because it's going to probably follow what its other peers are doing. Now, you'll notice the moving averages are starting to move up again, right? And so when you see this pattern with the 20 and the 50-day moving average, this is usually indicative of a trend that's beginning to lift off and take off. When you have them kind of curled sideways and then they both turn upwards and they start to spread out, you see the distance between the 20 and the 50 is starting to get bigger. That's usually a sign of an impending trend and a trend that's starting to really develop. For those that maybe aren't comfortable or understand how to really work with moving averages, that's one of the behaviors you want to look for. Is you want to look for the moving averages to be close together, and then you want to see them spread out, with the shorter term moving average moving up more quickly than the longer term, which is always how they behave. When you see this start to show up, that's usually a sign of a market that's going to start expanding and a rally that's going to start developing. Now, of course, that's not always the case. There's always the chance that this kind of just keeps going sideways and we keep kind of chopping back and forth, in which case with the 20 will dip back down towards the 50. But this is a good sign that it looks like we're starting to pick up some steam and starting to look like we want to rally. One indicator is usually not enough to tell you that a certain trade's going to happen, but when you start to see a couple of them occurring together, that's a good idea that it's going to happen. And so this is a good hint for us that there's a possible rally coming. The next hint would be, of course, this ascending trend line showing the momentum building up. I don't know that we have enough to really fully get behind the idea of a rally, but like I said, when we go ahead and analyze the other three indices, the NASDAQ, the Dow, and the Russell 2000, we'll see that there's a good chance that the SPY is going to follow suit and follow them and rally upwards. But for now, it's kind of stuck in neutral as it contends with all-time highs. Again, we're right next to all-time highs, so despite the fact that we haven't broken them, that's not a negative. That's still a positive. We're just basically a couple of pennies away, or maybe a point away, from new all-time highs and an extension of this rally that's just beginning. If you want to go ahead and look at the bigger picture, we'll go ahead and pull out the old rectangle tool. and you'll see what has the market done since August, right? So if you look at August through November, we've been range bound. Uh, you know, we had this string of rising wedges as we pushed through and made new all-time highs, and then we really started to struggle at the start of September. Um, and we came back. We had a decent correction. We broke through that. Then we had another correction that kind of followed suit again, and it looked like the market was maybe setting up a double top. That did not happen to be the case. As you can see, we actually found support a little bit faster than the last time, and we started to make our way upwards. And as you can see, what we're doing now is we are breaking out of the previous range and trying to confirm that that is the case. And so this is normal price action behavior, and this is typically what you will see when a market is getting ready or an equity is getting ready to move past the previous base. You'll have a breakout above it, and then a retest of it, and then eventually that ends up being what you need in order to go ahead and move past it and start extending and stair-stepping your way upwards and beginning a new phase as you mark up through that area. And so what we're seeing here is a transition from what was previously a strong selling zone, or a level that the market considered to be of poor value, and now it's starting to become an area where the market thinks this is actually a good value, this is a good place to go ahead and buy. And that's what happens when you see support flip into, or resistance flip to support, and vice versa. And so what we have here is again a pretty bullish development where it looks like the S&P 500 is getting ready to move past its previous range and begin a move up until it starts exploring higher and figures out what the next ceiling is going to be. So again, this is pretty positive. This is not a negative. This is actually a good looking chart if you really want to go ahead and analyze what we're doing. So overall looks good. I think the only negative really is that we haven't broken out of this triangle. Now, there's a small, well, not a small, there's a decent chance that we fail to break out of this triangle, we come back down. If that's the case, considering the bullish scenario that I'm anticipating, we shouldn't really break through the moving averages, not even the 20, and definitely not the 50. So if into next week, or for whatever reason on Friday, I doubt, like I said, I doubt Friday we see any kind of real substantial price action. Matter of fact, I doubt even today we're going to see any kind of substantial price action from here to the close. But starting next week on Monday, if for whatever reason the market slows down and we start to lose this triangle and head back down, we don't really want to see him lose the 20-day moving average, and we certainly don't want to see lose the 50. If that's the case, then it shows that the market is not ready to rally, in which case we are likely going to spend most of December correcting or chopping back and forth, right? If we want to see a rally into the holidays, we shouldn't go backwards here. This is the point where we need to move forward and break out. So that's your first real hint. If you're worried about the market and you don't think that it's really ready to rally, it would be a move below this triangle, and more importantly, below the 20-day moving average, and then the 50. That's the point of reference that you want to take if you're trying to figure out if the market is too weak and not ready to rally. Now, obviously, if it's ready to rally, we're going to see a move outside of this triangle on Monday or Friday, and then an extension of that into next week. And so those are the levels that I'm really concerned with. I don't think that 343 is in play at the moment. Obviously, in order to get there, we're going to have to break through the 20 and the 50. And I think at the moment, when you have a trend that's developing like this, the moving averages tend to gain a little bit more significance. When the market is going sideways, the moving averages tend to not really have a lot of impact on where we go ahead and bounce and drop. But as we start to rally, they become a little bit more significant. And so if that's going to be the case, they should support price as we kind of move forward here and keep it from really dropping back below them. Now, if we look at the NASDAQ, we're going to see a similar picture. Now again, tech names have been struggling a bit. And so even though in the short term, it's a little bit positive that we're kind of breaking through this recent consolidation range, you'll notice the triangle pattern that we have here is actually weaker than even the one that we have on the S&P 500. Let's do this. All right, and so as you can see, the NASDAQ also kind of struggling a bit. All-time highs are up here around 303, so we are lagging a little bit, right? But again, in the bigger scheme of things, this is still positive. This is still a bullish chart. Now, You'll also notice, again, showing that capital is rotating out of tech and that we're seeing a little bit of weakness, we're still range bound, right? Matter of fact, we're still range bound from what we saw even all the way through all of August for the most part. So, you know, tech names still struggling a bit, still kind of dealing with money flowing out of them and into some of the smaller caps that, again, I think market participants are hoping for a stronger recovery than what we're seeing at the moment. Now, I expect some of these tech names to pick up some steam as we head into the holidays. I think, typically you'll see stuff like Amazon and Apple rally as we head into Christmas, and I think that might be the case again. If we take a look at Amazon at the moment and we look at their chart, and we examined them last week, by the way, and you can see what's happening here. This level here, which is kind of critical, is 31.75. We're trying to break back above it today. And if we can break that level, I think that's going to bode well for Amazon to start trying to make their way back up. Now, we also have a triangle forming here as well, right? And so as you can see, even once we break past 31.75, there's a little bit more work to be done before Amazon is really going to go ahead and try to challenge its recent highs or recent all-time highs. And what we're doing at the moment, again, is just kind of lagging behind what the market is doing. So again, we go back to the SPY for a second, right? And you see when the SPY was trading sideways, you saw the moving averages going sideways, then they eventually curled upwards, right? If we look at Amazon again, we can see it's lagging behind. The moving averages are still going sideways. They still haven't started to come upwards. And of course, they're not going to come up until Amazon's price actually breaks through this triangle and starts to climb upwards. So the biggest thing you could take away from this is that it seems like Amazon is probably a few weeks behind what the market is doing, and it's going to need to play catch up if it wants to rally. And the first thing it needs to do to break out of this triangle is actually get back above its moving averages, which it's doing today, and above this 31.75. The next step is to break this trend line, which is not that significant, and I think that as long as it breaks back above this level, it should break this trend line in short order. And the last thing we want to notice is this short-term bearish line that we looked at last week. It kind of lost momentum and broke down through it, but as you can see, there were enough buyers supporting it to stop this from dropping all the way back down into the low 3,000s and high 2,900s, which again is showing maybe we're going to see a flip here where we have a false breakdown that leads to a breakout upwards. So, this is the kind of thing we want to look at now. Is it ready to bounce? Like I said, it looks like it's starting to, but there's still some work to be done. If we look at Apple, which is the other tech name we want to look at, and we'll see a similar picture. It's still kind of struggling, doing something very similar to Amazon where it lost momentum, and then now it's trying to reshift and get back above its moving averages. Now, like I said, I think that these names are probably going to recover at some point in the next couple of weeks. We're not there yet, but those of you that like to trade in the tech names, this is not a bad spot to go ahead and look and keep an eye out and wait for the potential reversal and momentum to kind of pick up and start coming back into them. The only big tech name that has really done well is actually not even a FANG stock, but it is a new addition to the S&P 500, and that's Tesla. And as you can see, Tesla, same thing with the moving averages, right? And they're starting to curl upwards, which is indicative, again, of an emerging trend that is likely going to persist. We had a nice triangle pattern on them as well. And so what we're looking for is we're looking for the FANG stocks. And I'm wondering, I was having this discussion with someone the other day, are we going to have to add Tesla as a new kind of FANG name? And is it going to be part of this group? I already kind of consider it as part of that group, but it's not really there yet. But as you can see, it's leading the way upwards, and it's been a leader all year. And what we're getting here, honestly, are hints that these weaker names are going to start following what some of the leaders are doing right now. And so I expect a little bit more momentum to come into the FANG stocks and kind of follow what Tesla's doing and what IWM is doing in the near future. And it's just a matter of us making sure that we see an opportunity to take before we go ahead and just gamble. So we want to see a chart pattern develop that gives us good risk reward, and then try to take advantage of it that way. But back to the Qs and back to the NASDAQ, as you can see, very similar to what Amazon and Apple were doing, and where it's trading sideways and it's starting to pick up some steam, but it hasn't really broken through short-term resistance levels, and it needs to do that. And once it does that, then it can come up and challenge the more intermediate or longer-term resistance, which of course is really all-time highs. So despite the fact that it's lagging a bit, overall we're still again in a good place because we're very close to all-time highs, and we have what appears to be momentum building upwards. Now, what if I'm wrong here, and what if we end up selling off? What are the levels we want to look at to the downside? Well, just like the S&P 500, we've got a short-term trend line. I don't think it's very significant on the Qs because, again, it's not really connecting much here as far as price action is concerned. It's more of a broader picture of what's going on. But more importantly, the 20 and the 50-day. Like I said, when we have a trend that's starting to build, these moving averages take on a little bit more significance. And if we are indeed done trading sideways, then we shouldn't cross back through to the downside. If we do cross back through the downside, well, then there's a pretty good chance that we're going to have to come all the way down and test support. We have our first level of support down here at around 284, which is going to be right at the moving averages, and that should hold. That should probably hold for the rest of the year. If it doesn't, well, then we're going to come all the way down here to 273, and who knows what happens once we hit that level. Because again, this will be indicative of a market that did not want to rally into the holidays, which would be probably a negative and would likely mean that the market is looking to head a little bit further south. So this becomes a critical line in the sand for us as we head into December, and will be a good tell for us as far as whether the market really is strong or weak and what it wants to do. Now, my expectation right now is that this will hold and that we are still trying to rally. Now, whether we rally and fail is a different story altogether, but I think at the moment the market is attempting to rally, and if that's the case, then we should see it push outside of these triangles to the upside, not the downside. Next up, we have the Dow, and as you can see, the Dow Jones is picking up a little bit of strength compared to the S&P 500 and the NASDAQ. We had a breakout yesterday. Now, it's struggling to hold that breakout, but what we have again, and we'll change this trend line again, make it a little bit longer term triangle. What we have here is, again, the same triangle pattern that we're seeing on the S&P 500 and the NASDAQ, but as you can see in the short term, relatively speaking, the Dow is a little bit stronger, right? Because it actually broke out yesterday. Now it's still failing that breakout today, or right back at it. But overall, still showing a little bit more strength. And this again is an area that has struggled throughout the year, throughout last year, this year in particular. If we look at the moving averages, same thing, right? We had this sideways chop, and just like the S&P 500, actually stronger than the S&P. When we look at it from this perspective, if you look at that range we spent since basically August to September, and that potential double top that was developing, we have negated that and we're trading above it. So just like the S&P 500, we have broken through a range. We came back and tested it twice now and have found buyers willing to support price action both times. This normally resolves in an extension upwards and a breakout and a rally. Whenever you go back and you take a look at this pattern, when you have a broad base and you have a breakout and you come back and you retest it, and you retest it a second time if necessary, and then you start to move forward, that's usually when we start to really rally. So again, this is looking positive, and this looks like the market that wants to move upwards, not down. Just like the other two, if we do falter and we come back down, in this case, we're so far above 291 that we don't want to come back down to this level. So it's not just the moving averages we want to worry about. We also want to worry about this range. We don't want to head back into this range. I think with the S&P 500, we were a bit closer to that range, where if we lost the triangle, we'd be back into the previous range. So it's not the end of the world if we do dip back into the 353, 352 range. But with the Dow, we're clearly holding above that previous range. We don't really want to go back down into that. So What I would expect here is if we do sell off and we head back towards the bottom of this triangle and maybe break below it, we should find support up here at 291, 292 as the 20 comes up to meet price. And again, what we really want here is we don't want these moving averages to be violated. We want them to start climbing up. We want them to spread out. We want them to become the train tracks that push the price action up just like it did through a good portion of this year. And basically what it does every time the market rallies. Again, if you go back and take a look at what we were doing prior to the pandemic, it was the same thing. You have the moving averages, they were trading sideways, and once they start to spread out, you get a rally. And that rally usually persists for a while as the moving averages become these train tracks, and the momentum just keeps kind of going along them until eventually you break it, right? And that's how it goes. But we're looking for the same sort of development here. Again, we had that happen earlier this year, and then we had another sideways price action, and what we have right now is the same idea where this trend is starting to open up, and if that's going to be the case, we should hopefully see a rally that follows suit. Now, sometimes there's one last swing before it happens, but again, the fact that we've already come up and retested our previous range a couple of times and are back towards all-time highs, it leads me to believe that we're ready to rally. And so that's my expectation at the moment. Last, we have IWM. By the way, and if those of you that are in here, if you have any questions regarding this, or how I go ahead and analyze or use these moving averages or anything else, feel free to ask. Like, on these Wednesday market streams, I always ask for chart requests if you guys have them, and obviously if you guys have a chart you want me to look at, feel free to type it in. But if you also just have questions regarding technical analysis and why I go through, why I focus on some of these trend lines or these moving averages, feel free to ask. More than willing to help out and to give you guys more on my thought process and how I go ahead and analyze this kind of stuff. So the last index we want to look at is the small caps, the Russell 2000, which of course is through the ETF IWM. And in this case, you can see very clearly we've had a breakout, right? IWM is starting to become the leader, which is a very nice change of events, or nice change of pace, and something that we've been kind of waiting for a long time for. You can see the moving averages. Again, if we want to go back, we take our rectangle tool, and you take a look at our previous range, you can see that this is something that already occurred. So remember when I was mentioning with the Dow and with the SPY, how you have these bases, right? And then you have the breakout and you have the retest. This is how it normally behaves. Now, normally you don't get this. We had an actual breakdown here, which threatened to kind of reverse the whole thing, but then we broke out, right? But this is typically what you want to see. You want to see a previous base, you want to see a breakout, retest, and then you rally right through that. Hopefully without this little shakeout that we had on IWM. And so what you have now is we have a breakout, we have an extended rally, you have the moving averages again, you see they started to spread out and now they're moving up like train tracks. The 20 above the 50, both of them coming up. Price has not come anywhere near the moving averages yet. And so we are in the same place that I mentioned with the other three indices, in where if we do lose momentum and we pull back, we should find support at these moving averages. When you have a strong trend developing or in place, usually the first or even second test of the moving averages holds, and then it's not until you start repeatedly testing them that they start to erode and you start to see a slowdown and eventually a break of that trend, and you graduate towards a sideways range of consolidation. And at the moment, that's not what I'm expecting. I'm expecting this to continue and to persist. And so the key here, if we're trading, is to try to really gauge what areas are benefiting from the small caps, right? And where are we starting to find some pockets of strength that can be traded, and where's the weakness, and which of course we know a lot of that weakness is in tech right now, but we want to try to figure out just what kind of rotation is going on and what parts of the market we can benefit from. And so that was our focus a couple of weeks ago. And as you guys know, those that were here last week and obviously the week before, we settled on restaurant names as one of the areas that we wanted to go ahead and benefit from, that we thought would do well and will recover more quickly than, say, maybe airlines, right? And so we looked at some restaurant names, and not all of these are in the Russell 2000, but they all follow the same idea as what's causing the Russell 2000 to benefit right now, which is this theory that with a vaccine coming out, a lot of these beaten down sectors are going to do better. And so We had looked at stuff like RUTH, which is a steakhouse, and you can see again from when we looked at it back on the beginning of November, it started to rally nicely, right? Another one we looked at was Dave and Buster's, which has done decently and is starting to make its way back up towards the top of its previous range. And then Starbucks was another one, which again is kind of trading at highs and has done the same thing. It pulled back after that gap, and then we wanted it to buy it as it started to make its way back up once it kind of corrected off of that big gap up that we had on November 9th, which was the day that Pfizer, or the weekend that Pfizer announced their vaccine news, right? And so as you can see, in my opinion, restaurants are a good spot to look at that I think will benefit more quickly than, say, airlines. Now, some of the airlines have done well, or cruise lines for that matter. And as you can see, they followed the same behavior, right? They got down on November 9th, and then they've started to make their way and rally up. And you can see, relatively speaking, American Airlines is doing just as well as those restaurant stocks did. But I have more faith in those restaurant stocks holding their value if we get bad news concerning a vaccine. So I still trust them a little bit more. But stuff like that, or like Carnival Cruise Lines, or for that matter, maybe even like casinos, you can see that they all followed the same pattern. They had a big move up on November 9th, then they dropped, and they've kind of made their way back up. And so they're all doing the same sort of behavior. And that's what we want to do, is we want to figure out just how much of this is going to persist. And like I said, one of the areas I picked was restaurants. The other one was maybe real estate. You want to look at some of these real estate companies that are benefiting. So Simon Property Group, they own malls. And with an expectation of consumers being a little bit more brave and willing to return to the malls, particularly into the holiday season, you can see that this is a name that has picked up some steam and done a little bit better. So these are some of the areas that you want to look at. You don't want to necessarily just say, well, I want to screen small caps because they're doing good. You want to understand why the small caps are doing good and try to find other areas that are doing sort of the same thing. And we'll look at that in a little bit more detail as we move forward. But the picture here is, as you can see, is small caps are leading the way up. And it's up to the S&P 500, the NASDAQ, and the Dow to follow the leader and to break out. And so everything that I'm seeing when I look at all four of these markets together as an aggregate is a market that wants to rally as we head into December, as we head into the holidays. Now, could it be that we falter and that rally fails eventually? Yeah, there's a decent chance. Maybe even as we head into the new year. But for the moment, there's really no bad news that's really threatening the market. There's nothing hanging over its head. And as we head into the holidays and volume gets a little bit lighter, I expect us to kind of just drift upwards, which is what typically happens during the holidays, as some of the bigger trading firms or desks, they start to take their Christmas vacations, and so you have less price action coming in. Now, if we have news coming out of left field, if we have some bad vaccine news, then the market might get spooked and might drop. But for now, I'm expecting the market to just kind of continue what it's doing here. And the signs that I'm seeing is a market that wants to break out. And like I said, if it's not going to happen, well, we'll get the warning signal, right? We'll look at the moving averages. They'll tell us that things are starting to slow down. We'll see price go back to them and maybe through them. And at that point, we'll know to kind of back off a bit. All right, so let's take a quick look at the U.S. dollar. Let's look at oil, gold, and silver, which is acting a little weird, honestly, or at least gold and silver are. And then we'll get to, again, if anyone here has a chart they want me to look at, type it in and let me know. So if we look at the U.S. dollar, we're seeing a dollar that's starting to weaken again. It's starting to break down below a pretty critical range. And you're going to see the mirror of this as we move to the euro-US dollar cross, which again is going to be the opposite, right? So in this case, the euro up is good for the euro. So you can see that the euro is rallying, which means the dollar is fading. And you can see it's starting to try to break above this previous range. So the dollar is starting to show signs of weakening as we move forward. Whether this holds is still up for debate, right? We're still not really through that range. So there's always a chance that we get a reversal here. But for the moment, it's beginning to look like the dollar is starting to lose ground again. If we look at it versus the Canadian, We see a similar picture where we had a pretty good reversal yesterday, and it moved right back down to lows, and it's just kind of hanging by a thread, trying to hold that support. Now, it can find support. It could print another hammer. It could find, some kind of bullish engulfing candle to push it back upwards. It hasn't technically really broken support yet, but it's not looking good. Particularly when you look at the previous level of support, which is here, right around 134, and you can see that we had a breakdown that held, and now another breakdown back below that, and so it's looking like the dollar might falter again. If we look at the U.S. versus the yen, we see a similar picture. Now, in this case, we actually haven't gone back down to lows, but we're still struggling. We're still struggling to hold at what is support. Now, just like the other two, we had a break below that base, and we're right back there now, but it's not looking great. Of the three, this is the best looking as far as a chance of the dollar holding value. But overall, it's looking like the dollar might falter. Now, the weird thing is, if that's the case, we should see gold and silver doing well, and that is actually not the case. Gold had a breakdown as well, came all the way down to the 200-day moving average, and this is again kind of weird when you see the dollar struggling and you see gold and silver. They're typically inversely correlated, and pretty strong inverse correlation. When they're moving together, it's something that's a little bit more tricky to analyze, and I'm not really sure what's going on there. Like I said, I tend to trade more off technical analysis rather than fundamentals, even though I will mention them sometimes. And I don't know why gold and silver dropping with the U.S. dollar, but that's what we're seeing. And so at the moment, it's a little bit trickier. You don't really, like I said last week, if you wanted to trade these, you wanted to see the dollar break down, but you also wanted to see them get back above these levels. And they didn't hold above them or even get back above them. For silver, it was this 2280 level, and for GLD, it was at the very least they needed to hold above 173. And as you can see, it obviously cratered and fell right back through there. Now it's at the 200-day moving average. There's a decent chance it bounces here, particularly as we see the dollar weaken more. But I'm not interested in this trade right now. There are plenty of other areas in the market that are more interesting, that could give us better return than trying to gamble on gold and silver right now with what they're doing. So I don't really have much interest in that right now. Now, the other interesting thing is oil. We discussed oil started to strengthen up last week, and as we can see, we have a clear breakout here. We have a nice breakout and a move up. Now, this is good and bad, right? Because again, higher oil prices lead to more pressure on our economy, but at the same time, when you have an economy that has been kind of shut down for an entire year, this is actually a sign of the economy trying to open up, right? And of energy demand and energy consumption going up. So this could be seen as a positive, despite the fact that you normally don't really want to see oil get too expensive. But we're seeing oil break out. This was a critical level, this $44 level, and we've pushed right through that and moving up to 45. So we're seeing energy start to pick up, and interestingly enough, and this is a trade that I missed actually. Energy has actually been doing well for the last month or so. If you look at what it's done, even over the last 3 months, it's been picking up some steam and it's been doing better. For those of you that may be wondering, if you go to finviz.com, there's a lot of great tools on this website. Whether you want to look at screen for stocks or whether you just want to figure out what's doing good on a certain day, you could just go to the heat map. You can take a look at what's doing well compared to the rest of the market. You can see this, the market for the most part is kind of red today, and we got some little pockets of green here and there. Biotech, which of course is one of the IWM small cap areas, maybe with some green there, and a little bit of real estate, like I mentioned before, and then some of these more safe consumer names like Walmart, Coca-Cola, they got a little bit of green in them also. But this is a good way for you to go ahead and take a look at that. But what we want to look at today is the groups, and you want to see what has done well recently. And as you can see, energy has done pretty well, and consumer cyclical stuff, which tends to be, is actually done well throughout the year, especially if you look at the half year and the full year. But the big thing was energy. Energy was up, and it's down today, but that's only because it's kind of taking some profit. This was actually really doing well yesterday as well. Um, and so, this is some of the things you want to look at. From there, maybe you go to the screener. And then from here, you go to the industry or even sector, right? You can go to just screen by energy. You got 296 charts. That's a lot of charts to look through, but you can go from there. You can say, well, I want to look at, say, oil and gas refining, right? Oh, I double click there. And then from there, we go to oil and gas refining. We should get a little bit less. Looks like it. Let's go to a different one first. Alright. So there you go, 24 names, right? So you can go to the charts, and you can try to figure out what's doing well and why it's doing well. You can see, say, maybe like this one, BP, one of these BP companies is picking up some steam. And screen that way. You can look for whatever names, maybe like this one looks like it's holding up okay. Right? And so you'll see a pattern. Now again, this is a pattern very reminiscent to what we just saw with the airlines and the cruise lines and the restaurants and the casinos. So I think it's the same general idea here, that these are stocks that have been really hit hard because of what the economy has done throughout the year. And there's hope now that they're going to start to pick up some steam if we can go back and open up our doors and start going outside again. And so that's one way to go ahead and look around and try to figure out what you're doing. But as you can see, oil is starting to pick up some steam, and it's starting to show a little bit of momentum. And I probably should have been on this for a couple weeks now, but you can only trade so many stocks, and the energy trade has not been something I've been that interested in. But it is an area that has started to pick up some steam recently, and might even continue, because as you can see with oil, with crude, we are getting a breakout here. So this could be a shift in market trend that we may want to continue to pay attention to as we move forward into the next not just month, but the next few months or year. Is some of these energy names start to pick up after they've been shut down for an entire year. There's a lot of room for recovery on some of them, and so there's a decent chance that they start to do well as we move forward. All right, so that covers oil, gold, silver. The only other thing I want to point out is Bitcoin. So for those that are wondering, here's another. This is a nice store of value that is, in my opinion, outperformed. Well, not in my opinion, it's a fact. It's outperformed gold, but in my opinion, is probably a better store of value and a better place for those that are against the U.S. dollar or don't like the trends that have been happening with the U.S. dollar and the fact that we keep kind of debasing it by printing more money, or having low interest rates, if interest rates at all. Traditionally, people flock into gold in order to protect themselves from an eroding currency. And I think nowadays the better choice is Bitcoin. As you can see, it's doubled in value just since September and October, gone from 10 to almost 20,000. Is it a good buy now? Probably not. But for those of you that, this is something we've talked about for a few years now. And I understand this is a stock stream for the most part, and you guys are following me to see kind of what I think about the markets and what stocks I'm trading. But I always want to point out different ways for you guys to improve your trading and to diversify your holdings. And for those that maybe have always kind of felt skeptical or stayed away from some of these cryptocurrencies, I think you're missing out on some big-time potential profits. And in this particular case, on a really good long-term investment. Just like I said last week when we were discussing stocks, how I think Amazon is probably the best stock that I would, or the stock, my favorite stock to recommend as far as someone that wants to start a long-term portfolio. I don't think anyone that wants to have long-term holdings, I don't think anyone should not have at least some Bitcoin in a separate portfolio somewhere. Now, is it worth buying now? Like I said, I don't think this is a good spot to buy it, we go ahead and look at a weekly chart and we see where it is and where it's been, you know, it's getting up to some pretty difficult levels to break through. And you need to kind of, you know, for long-term stuff, you want to buy a value. You want to buy when it drops. So now would not be the time. But you need to watch this because it's challenging some critical levels. And once it breaks through, there's a lot of room for it to move upwards even more. So if it drops back down into the lower teens or tens, this is something you definitely want to keep an eye on. Alright, so like I said, that covers it for pretty much everything that I wanted to look at. So if you guys have any chart you want me to look at, feel free to type it in. If not, there's really not much more to discuss. Like I said, one of the focuses that we've had over the last couple weeks has been restaurants. And so like even if you go back a few weeks, we were in Red Robin Gourmet Burgers. We've been in this trade for a while now, and it's done really well for us. Now the one that has not recently done well for us, I was looking at Chipotle this week, and it actually hasn't broken out. But we're not in the trade yet because it never broke that triangle. But this is maybe one restaurant stock that hasn't really broken yet. And if anything, is looking to do the opposite. But if it does break out, there is still potential for it to move upwards. But like I said, as far as the areas of the market that are recovering, this is one of the spots I prefer. I think I prefer real estate and I prefer restaurants over stuff like the cruise lines or say like AMC theaters, which again has rallied very well and has broken out. And you've gotten the same return out of this, if not more, than I would have gotten out of some of my restaurant names. But I feel like these names, if we do get bad news on a vaccine, these names will suffer more quickly than the restaurant names. But again, those of you that are actively trying to figure out where money's rotating, keep an eye on these areas because again, even this one, which is something that I avoided, but this was a big move, right? Going from the $2 and or maybe I guess say $3, all the way up to about $4.50. That's a pretty big return. You're looking at 33 to 40% return over the course of 2 or 3 days. So there are areas here that are starting to recover, and you know, if you look at it from a weekly chart, there's a lot of room for them to make up lost value and still not necessarily be trading at highs. So keep an eye on some of these names because they are starting to build up some steam and they're starting to pick up momentum because, again, vaccine hopes are lending some credence to the fact that they may be able to finally open up their doors and get back to normal. Alright guys, that covers it again for today. I want to thank those of you that came and attended for watching. If you didn't want to ask a question in public for whatever reason, you can always message me on Twitter. You can try to DM me. You can find us on our Discord. I'd be more than happy to answer your questions there as well. Other than that, I hope you guys have a good rest of this week. If you're in the U.S., enjoy the holiday break. If you are outside of the U.S., well, enjoy your break from us. And we will meet again next Wednesday.